So let's bring in Jeffrey Gundlach now, the CEO, CIO, co-founder of DoubleLine Capital. Jeffrey, it's good to see you. Welcome back.
Nice to be back on Fed Day, Scott.
Yep, and it's good to have you. First and foremost, your reaction to what we just saw.
Well, I think you just said the most important word, which was unlikely. Unlikely the next policy move will be a hike, and he went quite out of his way to make it sound like they're not contemplating a hike at all based upon the data that's come out, even though he's being a little bit disingenuous by claiming that inflation is below 3%. Remember back at Jackson Hole in 2022, I think it was, we came up with supercore inflation, supercore CPI, supercore PCE, and supercore PCE, which is excluding food, energy, and housing, is up 3.3% year over year. And what no one wants to talk about is supercore CPI is up 4.8% year over year. In fact, the CPI for the first quarter here in 2024 at year end was projected to be 2.7 on an annualized basis. Instead, it's 3.5 year over year on the headline. So it almost feels to me like he's hoping that the inflation data comes down without a rate hike. And I guess he feels that the lack of progress, as he framed it, during the first quarter is going to be transitory. So we'll see. With oil prices at $80 a barrel, I'm not really sure we're going to see the inflation numbers come down in a sustainable way below 3%, particularly not on the core numbers. So the markets, as you correctly pointed out, love this because there was fear of a lurch toward some suggestion of maybe contemplating a rate hike, and that absolutely did not happen. And so you just saw everything go vertical to the upside. You know, stocks went up a lot, junk bonds went up a lot. I mean, we had corporate bonds and emerging market bonds down earlier in the day, and they're now significantly in the green. So this is a interesting thing because the big pivot that started everybody getting happier was November 1st. And interestingly, rates are up a little bit since then, but not very much since then. So we've basically had rates go up and then come back down and go back up again. We've definitely been in a trading range for the fixed income markets and more recently sort of the equity markets as well. And this meeting and this press conference suggests to me that that's going to be sustained.
It certainly sounded like I guess we could say, a not yet chair versus a not at all chair, at least when it comes to rate cuts. I want to note going in that Goldman is still sticking to its view of 2 cuts because they say the 2 pillars of disinflation are intact, those being lagging housing data and the fact that we don't have any more supply shocks. I'm curious as to what your take is now. When do we get the first cut and how many will we get this year?
It seems unlikely that we're going to get 3. That was in the Fed's dot plot back in March. I actually, based on what we're seeing in the inflation market and commodity prices, which have been weak recently, but they're pretty much at their 200-day moving average, oil is up. I kind of feel that the base case now is 1 rate hike for this year.
Cut.
And I certainly don't think it's...
You mean cut?
Sorry, yeah, cut. Yeah.
Freudian. It's a Freudian slip.
got it backwards. But I don't think it's coming in June. I just don't see how that could possibly happen. There's just not enough data, and he certainly respects the fact that, I mean, lack of progress on inflation. That was not unanticipated that he would say that because you can't disrespect the data. I mean, it is what it is. But I thought one interesting takeaway that I got was he mentioned that a couple tenths in the unemployment rate would not be a catalyst for easing. I had the feeling that he needs the unemployment rate to get up to 4, maybe 4.2 even. And so we'll see what happens there. The unemployment rate has been up a little bit, but clearly it's not to the point where the inflation fight is less important than as the dual mandate, because the jobs part is behaving quite well, and the inflation rate clearly is the one that is lacking progress, as you put it. So I'm going to lean on one rate cut this year. I certainly don't think 3 seems very likely at all. So that's where it is. I think that higher for longer seems like the mantra continues, but without a rate hike. So this is a pretty good environment. The type of strategy that we've been advocating and implementing seems like it's going to keep working. It's been working really well for the past 6 months. And that is, that you can get pretty good yields by investing in securities in the fixed income market that aren't that risky.